Thank you very much, Jason, and thank you very much for the opportunity to speak at this virtual conference. And hello, everyone. So let me first very quickly introduce myself and my professional background, and then our company, Quantpedia, the encyclopedia of quantitative trading strategies. And then I will talk about how traders can use academic research as an inspiration for developing new trading strategies. Let's start. So my name is Radovan Vojtko, and I'm former systematic portfolio manager. In the past, I worked for Data Asset Management Company, which is the biggest asset management company in the Slovak Republic in the European Union. It has over 2.5 billion euros of assets under management. I personally manage over 300 million in several quantitative funds. These funds were focused mainly on multi-asset, managed futures, trend following, global tactical asset allocation, market timing, and volatility trading. And what's Quantpedia? So now let me tell you a few words about Quantpedia. It will be very fast, and then we will move to main part of the presentation. So Quantpedia exists since 2011, and I'm CEO since 2015. What's our goal? We are a quant research company. Our mission is to turn financial academic research into a more user-friendly form to help anyone interested in algo quant trading and systematic investing. We are continually building a database of ideas for systematic trading strategies, which are extracted out of academic research papers. Our research covers all main asset classes such as equities, bonds, commodities, currencies, or cryptocurrencies. How we do it, or how does it work? We are continually building a database of ideas and investment strategies which are extracted out of academic research papers. So we read a lot of papers from research portals, financial journals, universities, etc. And we select the best and write short reviews so that our users can faster understand the main subjects of these papers. Plus, we extract performance, risk characteristics, trading rules in plain language. And users then can screen our database, they can learn from research, and they can look for inspiration. The subset of strategies contains other sample backtests, replications, together with equity curves, trading statistics, source code, etc. So users can continue exploration. Or they can just check if auto sample performance matches the in-sample info from the source research paper. The reason for that is that we want to help our clients to look for inspiration, but also to check if the research papers is correctly written and if the things which are written in the research papers are working. Okay, in this presentation, I will try to explain the advantages of using academic research in quant algo trading. So I will try to answer a few common questions which are related to academic research, and mainly its role in quant trading. So I will give you one very short and simple example of a less common trading strategy, which can be extracted out of academic research, so you can see how it can work, basically. So the first question, who publishes academic research? There are tens of thousands of research papers which are related to algo trading and systematic investing, and which are published every year. Most of the research is produced by academia, professors, PhDs at universities, but the significant number of papers are published by professionals, asset management companies, brokerage houses, etc. A lot of the research can be easily found via Google Scholar, or there are various specialized databases like SSRM.com and so on. Now, why would somebody publish a working strategy? So if you are an academic, then it's simple. A lot of academics are very curious, so they are doing research in a pursuit of knowledge. They want to show that they have bright ideas and they want to let other people know about it. So it's also a way to climb an academic career ladder. So it's a possibility to start a side business as a consultant for some hedge fund, or start a fund on their own. And why are the asset management companies publishing working trading strategies? Because they want to raise more assets. So there was a very strong shift in transparency after 2008, and a lot of hedge funds publish a lot of academic research to show their expertise. So it's a way how to gain the trust of pension and sovereign funds and family offices. So you want to show knowledge so that the other people will understand that you understand what they are doing and you will be able to raise knowledge. Okay, another common question. So once published, will strategy stop working? So there are a lot of papers or research papers which answers this common question. And the answer is no. So strategy usually doesn't vanish. Yeah, yes, there is a decrease in profitability after anomaly or strategy is published, which is logical, but the returns do not weaken instantly. So it's not easy to arbitrage market anomalies. So most of the anomalies, they have a time varying return. So the fair part of the return is preserved as arbitrage is not risk-free, and fair part of the return is preserved also after the paper, after the strategy is published. And also out-of-sample return of published strategies can be attractive. So for example, I highlighted one paper. We can take a look on a paper which is written by Han and Yang, which is called Decomposing the Factor Momentum. And as we can see in the following chart, the buy and hold strategy of published anomalies is profitable. So once you take the anomalies, you will take a look when they were published, and you will, and in case you will hypothetically invest only in anomalies which were published. So there is a decrease in performance compared to the past performance which is in the paper, but the anomalies are still profitable. Moreover, the decrease in strategy's performance could be avoided by early adopting the ideas from the working papers. So it's possible to rotate among multiple anomalies or multiple factors, trying to pick the best performers, trying to pick the best strategy and include this set of anomalies and strategies in a diversified portfolio. So for example, as an inspiration, again, I just highlight the paper written by Arnold Clemens Kalesnik, which is called Factor Momentum, and which is taking the anomalies which were published, picking the best performers and investing only the best into the best one. Okay, the question. So do investors mimic or copy ideas out of academic research completely and without the change? No, it's not the case, not at all. So academic research is usually used only as a source of inspiration. So in practice, every fund, every portfolio manager, every investor implement ideas differently. So no company uses strategies as they are described in the research paper. Each investor always uses different definition of factor strategies, different trading rules, mix them together differently to suit the better needs. So it may look like the strategy is very well known, but it may not be crowded because it may be used very, very differently in different companies, and there is still space to use it. And the most important question for everybody, so how can I or how can we use the academic research in our trading? So we can gain a lot of knowledge out of the research. It will give us understanding of what different types of trading strategies exist and examples of them. So we can learn something more, something new. We can gain access to the reasoning of the large hedge funds and asset management companies. So we can better understand how professionals structure their portfolios, what are the important things, what are not important things, how they are building the portfolios, and so on. And it will also give us ideas for our own strategies. So we can use academic research as an inspiration for the development of new investment and trading strategies. And so the best way is to give an example. So let us show the usage of academic research in trading. So the best course of action is to try fundamentally understand anomalies which are described in academic research, and to then explore the functioning besides the original scope of the research paper. So I have prepared one very, very short example of a trading strategy which is extracted out of academic research, and then I will show you how we can port that idea into another investment universe. And the strategy which I prepared for you is, the goal of the example is to explore the skewness effect. So what is the skewness? Skewness is the tendency of assets, or the skewness effect is the tendency of assets with the lowest skewness, the negative skewness, to outperform assets with the highest skewness, with the positive skewness. I will give you one example. So the skewness ratio represents the extent to which the distribution of curve is distorted. So in a data set, if a data set, for example, daily performance of an asset, I don't know, some commodity, is symmetrically distributed, the value of skewness is 0. In the case where the majority of data set values is concentrated on the left side, we talk about the positive skewness. So what does it mean? We have a lot of small losses or a lot of the performance around the 0 and few big winners. On the other hand, when the majority of dataset values is concentrated on the right side, we talk about the negative skewness. So what does it mean? We have a lot of small gains and a lot of the performance around 0 and few big losses. And now the average value of dataset is higher than the mean value in the case of negative skewness. And the best example of skewness effect in trading is a research paper from Fernandez Perez and his team, which is called The Skewness of Commodity Futures Returns. So the team around Fernandez Perez, they checked the skewness in returns distribution for a group of 27 commodities on the futures. Based on the findings, the researchers proposed the trading strategy of going long on commodities futures with the lowest skewness and going short on commodities futures with the highest skewness. So clearly, the strategy is profitable, but it has one more additional feature, which is very favorable, and I will show you in the next slide. Our research suggests that the performance of the equity market, represented by the S&P 500 index, is negatively correlated with the performance of the skewness strategy. So therefore, if the equity market performs badly, the skewness strategy should be profitable. So if you look up the worst months of S&P 500 index, which are the blue bars, and compare them with the performance of the strategy, orange bars, we will see the performance of the suggested strategies is at most times positive, and therefore the investor will be able to hedge his equity portfolio. Now, the logical question is, why are negatively skewed commodities outperforming the positively skewed? The reason for that is behavioral, and it's also written in a research paper. So basically, it means that investors are looking for lottery tickets. So investors usually prefer assets which are positively skewed. So they usually prefer assets which have very, very big gains. And it means that these assets are usually they are very expensive. And in case we are shorting these positively skewed assets and buying the negatively skewed assets, there is a difference in performance. And now, how you can build on the original idea of using the skewness ratio to sort commodities. So once we understand how it works, we understand the paper, we understand the reason for that, the interesting course of action is to try to change, for example, the investment universe from futures to ETFs. So we tried it for this presentation. We picked the 14 most liquid individual commodity ETFs, like ETF for US oil, for natural gas, gold, silver, platinum, palladium, and so on. So 14 most liquid individual commodity ETFs. And we built the trading strategy with the simple rules of going long the most negatively skewed ETFs, and going short the most positively skewed ETFs. Backtest starts in 2011 due to we need to have a lot of ETFs, so we need to have enough ETFs in a sample, and it goes until 2020. And it seems that the anomaly is present not only in commodity futures, but we can trade it also in liquid ETFs. And now, thank you for attention. So this was a very, very quick presentation, and I hope you liked it. You liked this short presentation. And I hope that I was able to motivate you to incorporate academic research into your process of finding new ideas for trading strategies and to learn something new. And in case you have any questions, I'm open to answer them. Right now we have a few minutes. Feel free to ask them.
Hi, everyone. Yeah, I'm Rémy. I'm the CEO of Vauban. I'll get back later on after my presentation on what we do. I think you're going to have a lot more substance to understand, what we do as a company afterwards. So yeah, I'm going to share my screen. My presentation is going to be on a certainly more boring subject than the two previous ones, which is the sort of back office aspects of launching a fund. So I think it's going to be really quick, but it's going to have key information about, when should you think about raising external money and launching your own hedge fund. What do you need to do that? What's the process like? What are the common pitfalls, etc. So yeah, I think the first question everyone wonders is, when to actually launch a fund. Should you get started as early as possible, or should you wait as much as possible? The answer is, of course, it depends. So what we tend to see when people launch, people that launch a hedge fund, is that they're typically going to have at least a few $1 million to get started with. These hedge funds are generally seeded with I guess friends and family money and very early seeders. It's very it's hard to access like more institutional money if you're just getting started, if you don't have like a track record. So the second thing you would need is to have a sort of track record. So you would need to have done some prop trading for at least 1 or 2 years with delivering consistent returns. There's something you can do, which I know it's a new service these firms offer, and I don't know if a lot of people are using it. But essentially, if you go to one of the big four, or one sort of accountant consulting firms, you can go to them and they would use your sort of they would go to your IB account or Alpaca account and just audit all of your track record, and then you can. I think it makes it easier to raise money if it has that stamp. That's actually the performance you delivered. Something else, and we see that a lot in all of our algo trading clients, is that fundraising and the fund operation, it's an actual job, and it's just going to take you a lot of time. And ideally, you really want to team up with someone that's going to do that. Like, I think even give equity, in your investment firm to someone that's going to do that. Like, it might feel like it's not a good idea at first, but I mean, believe me, like it's really, really, really worth it. It's a bit like if you're launching any company or startups, right? You're going to have a lot of, but you have even much more for funds because it's regulated. You're going to have a lot of, admin things to do, operation things to do. Fundraising for a fund is hard. I would say probably harder than for a startup or for a company. So ideally, you want someone dedicated to that. So be careful of the chicken and egg problem. And to be honest, that's like all chicken and egg problem. It's a very hard one to tackle, and there's no magic answer. But essentially, you don't want to launch a fund before you have investors, because it's going to cost you a lot of money, and if it doesn't increase significantly the capital that you're managing, it might not be worth it. But on the other hand, when you're going to see investors, a lot of them will say, come back when you have a fund I can invest in, right? And they don't want to waste their time sort of checking. They don't want to make a promise if the fund doesn't even exist and it's not even up and running, and they don't want to spend time going through your track record, etc., if the fund is not up and running and might never be up and running. So I think you need to do some arbitrage about checking whether checking whether you if you have like significant interest and you want to get started, get your fund up and running. But at the same time, you don't want to start too early, because again, it does cost a lot of money. We'll come back on that later on. Ideally, you will need resources to live with no or very little income for a while. There are a few reasons to that. The first reason is that emerging funds at the beginning, they tend just not to be a very lucrative business model, because even if you deliver, you make the performance fee and management fee calculation. If you just have a few millions under management, it's not gonna bring you tremendous amount of money, and most likely all of these you're gonna have to spend it in managing your investment, maintaining your investment management firm. The second reason is that you will probably come to investors with, like a 2% management fee, 20% performance fee type of approach. But if they are your first investors, in 99% of the case, they will like negotiate very, very toughly on that. So, they will probably reduce the performance fee to something like 10%, the management fee to something like 1%. On the performance fee, you're going to have a high watermark. You're probably going to have a hurdle rate, which pays no fee as well. And like generally people that launch hedge funds, it tends to be not very lucrative at the beginning. The good news is that when you pick up the momentum, and after 1 or 2 years, when you start having one sort of bigger investors, then it's a very sort of positive circle. Like, I mean, we've seen that with our clients where they can get from $2 million to $40 million in 3 months, if you just hit the right spot at some point. So once it actually gets started, it can get really, really quick. I think the things you should avoid when launching the fund. So I think it's going to be a bit of repetition of what I just say, but fundraising is a lot of work. It's a very different skill set from algo trading. So I think you might want to have someone in your team that's going to fundraise for the fund full time. So the chicken and egg problem that I mentioned. Something, and we see that with our clients, this is not very clear at all. It's important to understand the difference between the manager and the fund. I think I have a little structure here. So the manager, it's you essentially. The fund is an entity, a legal entity that's going to pool your investors' capital. It's just an entity with no employee, nothing, and it's going to pool your investor capital, like, I don't know, $5 million. And then your investment manager, it's called like, I think an investment advisor in the US, like a RIA, but essentially it's the entity that's going to provide service to the fund. So this service is going to come in the form of investment advice, like, ever manual one, or in your guys' cases, automated. And you're going to charge fee to that fund for that for that like investment advice, which is your management fee and your performance fee. So some fees are charged to the fund. Of course, your management fee is charged to the fund. You're charging your management fee to the fund. You're charging your performance fee to the fund. But there are other back office admin expenses that are charged to the fund. And these are, I mean, we get on that later, but these are like the fund administrator, which is essentially the accountant of the fund fees, the legal fees that you expensed in the, in setting up the fund, etc., etc. What's important to understand is that the performance is net of fees, and that's what you're going to charge your performance fee on, and that's also the actual IRR numbers investors will be looking for, and that's what you're going to be judged on. So it's very, very, important to understand that the fees that are paid by the fund, they actually reduce your, your rate of return. So the more admin fees, the more expensive you pay your content, etc., the higher is going to be to provide, like a performance that's way above your index. The manager fees, they're gonna hurt your, your management fee and your performance fee. So this is fees that you're gonna pay for you. So, when you get started, I guess you don't need that. But if you had like a building, staff, etc., that's paid by the manager out of the management fee. And it's very important to understand your relation. One of them is going to reduce your income personally as an investment manager. The other one is going to reduce the investor income, so the rate of return of your fund. So I think be lean. I mean, it's not a thing you should avoid, but like I think for that reason, it's important to start like very, very lean. And we see a lot of people that they want to get started and launch a hedge fund, and they think like money is going to flow through very, very easily. So they get the most expensive lawyers, the most expensive auditors, the most expensive accountant, the most expensive everything, and most of them tend to regret doing that because it's very easy to upgrade your structure later on. So we always recommend people to start with the most affordable structure possible, because again, otherwise you're not going to be able to provide a great rate of return anyway. So these are words I mentioned before. I guess most of you are familiar with us with them, but they are key terms to understand. So these relate to your performance fee, which for most hedge fund managers is most of the income. So high watermark is a concept that means that investors will only pay for performance performance provided above. You really need to think of like watermark. So for example, if the value of a share you fund goes from 1 to 100, so you perform 20%, you're gonna charge your fee on the 20% performance, the 20 increase that you generated. But if then the net asset value of each share goes back to 110, and then you go back to 120, the investor's not going to pay that because they already paid fee for that performance. And that's why you see a lot in the news where an investor, if a fund took a very high drawdown, like minus 30%, they tend to redempt and they give investor back the money and just stop all operations. And the reason for that is because it's going to take them 5 years to get back to their high watermark and to be able to charge a performance fee again. And it's just not a sustainable business and not a very lucrative one. Big hedge funds, like if you go to, I don't know, Citadel or Bridgewater, etc., they generally don't hire high watermark, and they still manage to convince investors without having them. But it's just because of the brand and the size, etc. Like for most, I think most funds really do need that, and investors will not invest if you don't have that sort of terms. Soft and hard hurdle rates, that's also something investors will request. So it's a performance until which investors are not paying performance fee. For example, something very common is that they would put they would peg that to an index, like the S&P 500 or something. So unfortunately, it means if the market is very bullish and it's up like 15% every year, you're going to need to provide like tremendous performance to be able to charge fee. We also, it's not always pegged on an index. You can just say, okay, then it's going to be 6% per year. That is going to be performance free. Essentially, it's a size of performance that's performance fee free. So this is more about the how to launch a hedge fund. So there are a few things to consider. The fund, as I mentioned, what's here is really a legal entity that's gonna pool your investor capital. That's where your investors will send money. We call it subscribe, to your hedge fund. There are different options. The most popular options for people who are not in the US tends to be the Cayman Islands. It has something like 20,000 hedge funds or something. And the reason for that is mostly, market standard and neutrality, like tax neutrality. So, everyone subscribes from all around the world. And because there are no taxes in Cayman, everyone just pays taxes in their own country. So this is going to be your favorite options if you want to raise money from outside of the United States, from I don't know, from Asia or from Europe or from LATAM, etc. The BVI is similar to Cayman and it's a little bit more affordable. So we tend to see it as a very popular option for emerging managers, especially we've seen in Canada or in Asia. It's becoming a very popular option because it's very, very similar to what Cayman offers, but it's more affordable. Like the service provider fees are cheaper, the government fees are cheaper, and it's going to fit the same type of audience. I would say if you're going to raise money from big investors, probably go with Cayman, because their legal staff is used to these laws, etc. If it's if you really want to save costs, etc., I think BVI is a good option. Delaware is going to be the top option if you want to raise money from American investors. It's unlikely that non-US investors will want to subscribe into a Delaware fund, because it has various US tax implications subscribing to a fund in America. But yeah, and I think that's a bit of an issue people are not always aware of. But essentially, when you get started, you most likely gonna need to make a choice between focusing on US investors or non-US investors. And there's a structure called a master feeder that essentially you have 3 funds, one in Cayman, one in Delaware, that both feed into a master fund in Delaware, in Cayman. But it's a very expensive structure to set up and run. So, if you're getting started as an emerging manager, I would really not recommend that. I would, recommend focusing on Cayman if you have non-US investors, and Delaware if you have US investors. So these are all the costs that are involved. So again, I've separated it. On the left is what is going to be charged to the fund, so to your investors essentially, and that's going to hurt your net asset value and your performance. On the right is what you're going to pay yourself as a manager. So the fund generally is going to pay the legal fee for the setup of the fund, the administrator, which is the accountant of the fund, the bank. So bank accounts used to be free, but you're going to find that opening a bank account for a hedge fund is not always very easy, and the bank will always request either that you maintain a significant balance into the account so that you grow the balance sheet, something like $500,000, or they're going to request that you pay them a sort of monthly fee. And the reason for that is that hedge fund bank accounts are very high risk for banks. They require a lot of compliance. They incur a lot of costs for them. And they're not very good business, because you're generally going to send the money straight away to the broker. So that it doesn't really grow the balance sheet, which obviously they don't like, because it's their business model. So prime broker, prime broker is essentially like a broker, but that can do more, that offer more service to you. Like, they can provide financing facilities if you need like a credit line, or if you want leverage, etc., etc. The typical big prime brokers that you're gonna see everywhere are like Goldman Sachs Securities, and it's the usual suspect. For these guys tend not to work with small funds. They will want you to manage at least 200 or 300 million to establish a relationship. They're also going to want to charge a minimum monthly fee of like $10,000 or $15,000. So it tends not to be a favored option for emerging hedge fund managers. And I think in the algo space, we see people using like interactive brokers a lot, or I guess even better, you guys should use Alpaca, and it just works fine. There's no legal requirement or any sort of requirements to go with, one of these big hedge fund prime broker like Goldman Sachs, etc. at all. Optional, an auditor. So it might or it might not be optional depending on the type of hedge fund you choose and where it's located. You may need to appoint an auditor. If it's not the case, in America, it's not the case, you don't need one, but it could still be it could reassure investors. And the thing with auditor is that, investors around the world, a lot of them, they don't know any name of law firms that do hedge funds. They don't really know any name of fund administrators. They're not like household names. But everyone know like Ernst & Young or PwC. So sometimes people tend to blast money on the auditor. I would say $12,000 a year is really the minimum. Especially for algo trading, I think it's generally going to be more in the $15,000 to $20,000 range per year. Director, so essentially it's someone that's on the board of your fund that are independent from the manager, from you. Some investors may request that because it means there's a conflict of interest between you and the fund. You're charging fee for the fund. Your objective is to become wealthier, and your investors, their objective is to become wealthier and to make you feel lower. And because of that conflict of interest, after a certain size, and when you start talking to a certain type of more institutional investors, they will want the board of directors of your fund to be independent from you and to make their own decisions, etc. These guys tend to charge, at least $10,000 a year if you want someone that sort of understand what's going on. Custody, this is for your guys type of funds. It's it's generally it goes together with the broker. I think it's unlikely you're going to need an external custodian, when you're getting started. At the fund manager level, so this is a separate entity. So you're going to have the usual setting up Delaware LLC or C Corp or whatever if you're in the US, or the equivalent in the country you're located in. You're going to need most likely to be regulated as an investment advisor, the cost of which greatly varies. So I would say the US is one of the best places. It's very cheap. And generally Europe tend to be a little bit harder, actually significantly harder, and the cost of regulation is higher. In Europe, instead of getting your own license, especially here in the UK, emerging managers tend to rent one from someone that already has a license. And the reason for that is that maintaining compliance is just too big of a distraction for you when you get started, the cost of which is really non-affordable. It tends to go from $2,000 to $4,000 to $5,000 a month just for that cost of regulations. Then you have plenty of optional things. I didn't put all of them, but I think you can imagine, like a portfolio management system, Bloomberg. If you want an office space, if you want staff, if you want, a yacht, like you can really put whatever you want in here. But I would say at the minimum, you're going to need to maintain compliance with your regulator. And then you can do that from your living room or wherever you are. Like I think a lot of people are launching, especially in the algo space, are launching hedge funds without actual office space nowadays. So just a few words on what we do and what we are. So essentially, we're a platform to set up investment vehicles. So we have two big dimensions, which are hedge funds and venture venture vehicles in general, so funds and SPVs. So we're really a one-stop shop platform, an online platform to get started, with a lower cost and in a very easy manner to set up, any investment vehicle, so like a hedge fund or an SPV, that sort of things. So yeah, we put in a lot of emphasis on, bringing it to be a great user experience for you, and that you don't have to deal with, paperwork and all of the sort of professional services, back and forth. And, it's a very archaic space, right? It's very, very different. So, I mean, we do that for all type of funds and SPVs really, but I mean, on the hedge fund side, I think maybe 60-70% of our clients are, algo trading or deploying some sort of quant strategy. Yeah.
Yeah, if we can, I know we went a little bit over. Maybe we could wrap it up within the next minute or so, just so we can get Prodipta to speak.
Yeah, that's fine. So that was it, actually. That was really, I think I'm done now.
The agenda for today is very simple and is very short. It will be less about presentation and mostly about some demonstration that the platform that we are going to introduce, and it is called Blueshift. What is Blueshift? It is a platform that we have developed from QuantInsti, specifically based on our experience and request of our user base who are looking for a simplified pipeline for deploying algorithmic trading, or rather more generally systematic trading. So it is a cloud-based platform that supports strategy research, backtesting, live trading, and has built-in financial data, and also has a very vibrant learning community, and it guarantees IP protection. So what you can do with Blueshift, you can backtest and paper trade any trade ideas based on high quality data. Now, when I say any, that means whatever trading ideas you can translate into a series of logical statements. So the platform has absolutely no constraints what you can define as a strategy. For example, it can be a very complicated machine learning algorithm, or your strategy can also be simple that you just go long Mondays, whatever. The second thing, it is based on very simple APIs. And by the nature of its design and the infrastructure, it protects you against two very dangerous biases that most of the time creeps in your backtesting. One is the survivorship bias, and the second one is look-ahead bias. So this is an event-driven platform. That means you cannot have any look-ahead bias, and your backtests are always protected against survivorship bias because we curate the data and maintain a bias-free universe of stocks. Also, on this platform, you don't have to code twice to first test your strategy and then take it live. You code only once, backtest your strategy without any change, go live with that same. We'll see an example of that. And finally, even if you do not have a background in programming, you can still use Blueshift to your advantage. So we support developing strategies either using Python or using visual programming that we'll have a quick look very shortly. There are many upcoming features that are also coming up. One is more data, of course. We are significantly revising up our infrastructure to accommodate more data. And also we are introducing Python notebooks for open-ended research. So right now you can only backtest, paper trade, and live trade. So the first part where you actually discover ideas, that part is coming soon. Open-ended research using notebooks. TensorFlow support and backtest sharing and many other features coming soon. And sometime next year, we plan to go open source with the core engine that drives Blueshift, and also a bunch of other libraries to support Blueshift trading. What you cannot do on Blueshift, this is something that's very, very important to keep in mind. Blueshift is cloud-based, and you cannot use it for high-frequency trading. Just in case you are wondering why, because the kind of speed we require for high-frequency trading, it cannot be achieved using such a cloud-based infrastructure. You need colocation or other very, very dedicated hardwares for that. And also, we do not support optimization. Why? If you have time, then we'll have an answer to that later. So the way Blueshift works is it follows the standardized systematic strategy design cycle. Just a quick recap here. I think most of you are already familiar with this cycle. Just in case you are not, the first step is selection of the universe. It can be a static selection, it can be dynamic selection. The second step is generation of signals for each of the stocks in your universe. Again, these signals can be independently computed, parallelly, or they can be dependent on each other. An example is that if you're computing PO time series momentum, they are independent. You can compute the signal for each of the stocks separately. But if you're doing cross-sectional momentum, for example, finally you have to rank them. So this ranking part is dependent. So that's an example. The third step, once you have computed the signal, is to arrive at the target portfolio that you want to achieve. And this target portfolio takes inputs of your signal computed in the previous step as well as your current context. Context means what is your existing positions, what is your risk management rules, and what is the cash in your account, and etc. etc. And once you have defined the target portfolio, the next step is to actually achieve that, which is the rebalancing. And rebalancing is a place where all your execution rules go there, whether you want to do it a market order or you want to do iceberg or something similar. And finally, of course, closing the loop is the continuous improvement. The way we do it is we follow a set of standardized APIs that has been popularized by Quantopian. We have a very different engine under the hood, but we stick to the Quantopian API. I'm sure many of you are already familiar. The reason we do that is that we find that they are very, very easy, especially for non-programming background folks to use them. So initialize is the function that you must declare in your strategy code. That is run only once, and that does some setup, what you need to do at the beginning of your strategy run, whether it is live or whether it is backtest. Before trading start, runs slightly before the market open. So usually it is something like 30 minutes or 45 minutes before the market open. Then handle data is called every minute. And then you have a set of APIs that allows you to do everything else, like a set for scheduling functions based on time, schedule functions, a set of ordering functions like order percent target or cancel order, and a set of functions to control your backtesting environment, your simulation environment, like defining the commission or defining the account currency if you're trading Forex, so on. So let's have a quick demo. I hope you can see my screen. And once you go and sign up on Blueshift, you landed up something like this. This is what you call your workspace. And this workspace is very similar to what you have in, say, for example, Google Drive or Dropbox. Is essentially a collection of strategies arranged in folders. You can create folders, you can create strategies. Now, for creating strategies, you have two options. You can either, as I mentioned, create it visually, or you can also use Python. So let's have a quick look at how to create a strategy based on Python. So you don't have to start from scratch. You can pick up a template from here. And once you do that, your template is opened in the code editor. You can maximize the code editor for better visibility. And if you look at it, it should be quite familiar in case you're familiar with Sublime. And in this particular example, all you are doing is that we have defined that function that we mentioned at the beginning. And we are defining a list of stocks as our universe you want to trade. And we have defined a function to be run at month start every month at the first day of the month, around 2.5 hours before the market close. And this function in turns actually rebalances all the securities within this, using this ordering function called order target percent. To know more about what this scheduling function means, what this order target percent means, you can refer to the help documents. I suggest that you first start with getting started. It's not very long, it's just a few pages. And then also, for better understanding, go through the tutorials.
Prodipta, I don't think we can see your live demo screen. It's still on the presentation, just so you're aware.
Oh, okay. So let me, oh, thanks, you actually mentioned that.
Righty, much better, thank you.
Yes, so I think the thing that we missed before is this page, which is the workspace. This is where you have all those folders and you have your strategy files. And this is how you create the strategy. You just type in a name and you select a template from here. We selected this particular template. It's a simple buy and hold template. So going back to the strategy we have already created, so that's pretty much it. And if you want to run a backtest, you can select a particular data set that you have. These data sets are curated for all the corporate adjustments, as well as I mentioned, to guard against any survivorship bias. And this backtest runs, it streams the data directly once you run it. We call this quick backtest, but it computes the minimum set of performance metrics, which we'll see on the top of the screen. But if you need a more detailed backtest run, what you can do is, instead of running a quick backtest, you can run a full backtest. And for that, you need to click the new backtest on the top and the same inputs. So it will start working in the background for full backtest. And you get a notification once this is run. This will come in your top corner. And once the backtest is also complete, you will get another notification. So this is pretty much straightforward, given you already are familiar with Python. But what if you are not? For that, instead of choosing to code in Python, what you can do is that we can choose visual programming for the same thing. So we are choosing the same template, buy and hold NOIC, and instead of using the Python coding, we are building visually. Now, this is a very interesting way of building strategies. This is based on a library called Blockly from Google and previously MIT. And I think some of you may be already familiar. In fact, the kids are these days more familiar with this interface than adults because it is used for two extreme purposes. One is to teach young people how to code, as well as to develop programming for IoTs and chips. So the way it works on Blueshift is that we have adopted this Google Blockly specifically for the purpose of designing quantitative strategies. And the first thing to notice here that everything here, your actions as well as your logics, as well as any computed value is expressed in blocks. So these blocks are movable and you can select and choose any blocks from here and build this entire thing. So here it works in this major 4 steps. First, you have to define the universe. If you remember what you've seen in the presentation, the first step is defining the universe. The second step is defining a signal. We call it alpha. Now, obviously, for this particular strategy, there is no signal. We are just doing buy and hold, so this is empty. And then finally, you have to define your trading rules. And trading rules is defined here as a scheduling action, which is scheduled at a particular time and day. And then we put our ordering block here. We define the size, we define the ordering type, and it's done. Now, we can run a backtest, but if you have already run the backtest and if you want to go live, this is as simple as clicking a button. So for example, if you're happy with the performance, all you have to do is to click go live. And this is where in the background, we make sure that your strategy is okay to be taken live. And once you accept any suggested changes, you land up in our live trading page. And here, there are some minimal 4 steps that you have to go through to launch your strategy from backtest to live without any change in your core coding part. The first part is to select your risk management. Now, many of us are either planning to come into algorithmic trading domain or already practicing it. Especially for the beginners, we have seen that most of the focus usually is on the development of alpha in the strategy. But if you ask anyone who is experienced enough, they will say that probably equally important, if not more, is managing your risk. And this is where you set up your risk. It's a part of it. The other part's risk that is specific to your strategy has to be within your strategy code. So here you have protection against drawdown. So it works like a kill switch. 5 means that if your strategy goes down by 5%, it will kill itself. And then this ordering and size limits are protection against fat fingers. So once you're happy with this and you continue to go to the next step is selecting the broker. So for example, here we are choosing Alpaca. So we have a complete end-to-end integration with Alpaca. It's actually a very great combination, Blueshift and Alpaca, because Alpaca, I'm sure as Yoshi mentioned, is totally API driven. And Blueshift is just adding a layer on the top of it, where you generate you code your logic, and the Blueshift generates those API calls. And for adding Alpaca to Blueshift, we have also done the complete integration of authentication as well. So if you have an Alpaca account, all you have to do is to go here, select Add Broker, and add one of these options that you need to. And you will be automatically taken to Alpaca page, and you can enter your credentials there and come back to Blueshift seamlessly. Now, after you select the broker, then you have to put in some more information like the amount of capital you want to launch this particular strategy with, and then just continue. And there is a default date here. You can also change this. We also have 2 execution mode for algorithms. So one is auto execution. That means whatever strategy orders are generated, it will be sent directly to Alpaca. There is a second mode where it will be first sent to you, and then you have to confirm before it's sent to the ultimate broker. So for Alpaca, we support the automatic execution, and once you accept the terms and conditions, the last step is actually to review what you're getting into. And once you're happy, you just confirm. So this takes you to the live page of Blueshift, where the default page is a console. So here, what you see is that what is the algorithm is doing behind the scene. So all these messages, they come up here just like a Unix or Windows console as and when they happen. So it can be either from your algorithm, you have used some print or log statement, or it can be from the broker, or it can be from the Blueshift platform itself. Also, if you have any errors or any warnings, they also come here, and everything will be color-coded. If you want to see the detail of the strategy, you can click at the trade button. Of course, there is no trade done yet. It will take a couple of minutes to complete that. And also the dashboard shows you the current value and positions and everything. So for example, if you go to my algo, this will list all the strategies that you are running right now. So for example, I have one already running for a couple of days, I think. It was started at 26th. And this is how it looks like. So you see that you see the equity curve of the strategy. You also see the overall parameters of the strategy, how it is doing, what is the cash left for this strategy that was allocated to this particular strategy, what's your MTM, what has been the drawdown so far, what has been your exposure and leverage, and also what has been your positions, right? Fortunately, this market open, all the positions are in green. And all the trades that you see here, they will come here. And the console will give you the latest thing. So for example, here you see a warning. There was a temporary drop in the internet connection, and it was automatically restored by Blueshift. So this is what you can do on Blueshift. And going back to the, yeah.
Sorry, I was just gonna say, as it looks like you were wrapping up the Blueshift presentation, is there anything you wanted to add real quick before we move on to the panel discussion?
Yes, so that's pretty much it. So I just want to touch upon a single thing which I mentioned before, and that is about, we talked about why we do not support HFT in details, why we do not support backtest optimization. Is just a few things I wanted to point out. And that is the reason is this. So we have learned about the backtesting and the live trading, and Blueshift doesn't support backtest optimization. The reason is the way we do a backtest, the scientific way of doing a backtest is you first ideate the strategy, then you test, and then either it works, it doesn't work, and then the correct way is to go back to the drawing board and come up with a new idea. But what we end up doing is that we try to tweak the data and try to fit some parameters so that we have a positive performance. And this is what is known as p-hacking. Now, if you are doing this kind of optimization, what is needed to be done is you have to adjust your Sharpe ratio for that. And this is some simulated data that we have generated in-house, where the number of tests is given here. So the number of times you have tried to optimize versus the corrected Sharpe ratio. So as you see the green line where you have run 1,000 runs of optimization, where the original Sharpe ratio was something like 1, the adjusted Sharpe ratio is in fact negative and deeply negative. So this is something that if you're using a backtesting platform like Blueshift, you should keep in mind. So I think I will stop here. And in case if there's any questions, we'll quickly move on there. And then we can get on to the panel discussion.